Hey, this is Jenny Jones, Digital Growth Hacks Club. I wanted to give you a brief explanation of understanding dilution in shareholder equity, definitely when it comes to buying lifetime deals and or tools when the founders come back to the well or they come back to the LTD space. And I want to make this as brief as I can. I've been in this area for 26 years, investment advising. I have a master's degree in finance and economics. And I wanted to explain some things to you. Definitely, I remember we had a chapter on mergers and acquisitions and or when it comes to investing and or going back for different rounds of investing. So I do remember those classes. Had to break out a couple of books just to kind of go over this. So this particular small video is brought to you by Hackpacks University. These are the things that we're going through and breaking down. We're trying to see if this is a good return on investment and trying to see if tools are of value. And what I stress to everyone is you have to buy these tools and deploy them quickly. That's the only way you're going to get the best return on value. You can't just be collecting tools. So let me do this really briefly. I just want to explain this to you because this is actually how it works in the actual real life, the way it works in the US. So I'm not really sure with other countries, and I'm assuming it would work pretty closely the same. But what I wanted to do, and I'm going to use an example, I'm going to use HeySummit as the best example because there seems to be a lot of buzz around that. And I'm going to give you my final verdict here, but let's just do a quick understanding. So hear me out here. So again, understanding dilution in shareholder equity. So dilution occurs when a company issues additional shares, increasing the total shares outstanding. So what this basically means is they're additionally, let's use it for LTD purposes. They're coming back and they're issuing additional licenses, right? So this impacts existing shareholders, which are the people who may have purchased it at a lesser cost and maybe lesser features. The ownership percentages, while their absolute number of shares remain unchanged. So it's like, hey, I've spent a dollar amount for it. I'm not getting anything additional for it, but you do run the risk of dilution. That's why the more a tool comes back, a couple things could happen, and you have to look at your overall value and you have to assess it. You can't be part of everyone else. You have to see if it works right in your particular situation. So let me move forward here. So what is dilution? New shares issued. So in this case, new licenses are issued through companies like an Appsumo. So companies issue additional shares for raising capital, employee stock options, or mergers. So use this as LTDs trying to raise additional capital, right? Ownership percentages. This does not apply to you because you do not own the company. You're just really an early investor indirectly in investing in the tool and the growth, right? And so it says and this is actually what happens. So existing shareholders maintain the same number of shares, but their ownership percentage decreases. So in your particular case, you're looking at it as though, whoa, so they're coming back, they're adding additional licenses, they're adding additional features. It looks like I'm getting left out. In actuality, their promise is to line it up with a certain plan. And as long as that plan remains intact, then you as original purchasers do a lifetime deal. It's not like they're bringing new features to the actual, if they're adding new features to the actual plan. So if it's a small, medium, large plan, and if everything was added to the medium plan, if they make that publicly available on their website, then you have a right based on what the founder is saying to those additional additions, right? So in this particular case, these are offerings. So if they came with an offering back in 2019, that was what it was at that particular time. If they come back to a new offering, what they're trying to do is entice new investors or indirect investors in the actual application to purchase a license. So they're making it more enticing. What all the while that does is increases your value because it comes back now and they've raised the price. So your original license does hold a higher price, depends on what the original cost is, because the new investors or the new indirect investors have to pay a higher cost. So it's justifiable because they're getting more features. So it's a higher cost associated with that, right? So let me just give you an example here. How dilution affects shareholders or indirect, in your case, indirect license holders. The initial ownership, let's say, for example, the shareholder owns 100 out of 1,000 shares. Let's just say, so they own a 10% stake, right? And or we'll use these in licenses, right? So what happens in diluted ownership is the same 100 shares after a company issues 500 new shares. So now it's 1,500 outstanding now, but your initial investment was diluted down to 6.67%, if that makes sense. Hopefully that makes sense, because listen, it was only 1,000 available. Now it's 1,500 available, but I still own my original 100, right? So, which I had a 10% stake. Now my stake lesser because there's more people in the pool. The look at that on the bright side of that is now you have a greater chance of the company surviving with the infusion of cash in new investors or indirect investors inside the tool or the investment. So however you're using the tool, if you paid a one-time cost for it, I don't know, $200, and you've been using it consistently, you make using it $200, and let's say you're making $1,000 a month just using the tool off a one-time purchase. You don't want that cash to stop coming in. You want to continue to make that $1,000 a month, maybe $12,000 a year off an initial investment of $200. So you have to look at it with a different set of lenses. And again, I always look at tools for intrinsic value. That's what we do here on the Digital Growth Hacks Club. When you are part of Hackpack U, we look at it from a different set of lenses. We don't look at it from a collector's perspective. We look at it for how can we get this tool, redeploy it, and make our money and get 14, 15 fold from our initial investment. That's what we do. That's why you have to follow the channel and possibly enroll in Hackpack U. It's getting hard out here on these streets, and we have to change the way we're looking at things. So this just gives you a visual of what would happen. And this happens every single day for investors or companies wanting to go public, or they're private, then they go public. So the impact on earnings is, hey, before dilution, you're looking at maybe a 2.5%. Then after you add more shares, then your earnings per share decreases right here to like maybe 1.5 or 1.25%. That's just the way it works. It works like that in initial businesses as well, right? In our case, and the reason why it doesn't seem like we're getting any value, because we don't own any actual shares. So what you own is the ability to continue to create revenue from said tool, right? So the negative perception. There is negative perception when it comes to founders coming back to the well, coming back to LTD. Markets may view dilution as a sign of financial instability, or companies needing capital may face investor skepticism. And usually when people say, hey, why are you back? Why are you back on Appsumo? And it's like, hey, we want to expand. And I think in the case of HeySummit, they're like, hey, we're looking at possibly an opportunity to be able to create our own type of streaming, right? And keep everything all in house, right? They're saying that would be an additional cost, because that's a serious cost if you're going to stream, because you need servers. You need to be able to have servers to push some of the technology to the edge of this of the network to be able to make sure that you're able to stream. So it's an additional cost with that, but they do want to add some different things. So that may be some skepticism there as well. Now, the potential for increased value, and you have to look at this with a different set of lenses, right? Capital raise. So new funds enter the company. So you've already been using this tool, maybe, I don't know, since 2019. You're like, man, I'm still using this tool from 2019. I'm making $1,000 a month off of my webinars or my coaching or something like that. I don't want this to stop off my initial investment of $200, right? The shareholder benefits, long-term capital gains despite dilution, meaning that you're still making money. In this case, with tools, you're still making money, right? Growth initiatives, investment in expansion opportunities, right? Now they're able to bring you more connections, direct connections, right? I think since they've returned to Appsumo, they've added VBAL, they've added a couple of other more direct connections. So it allows them to have money to be able to spend the time to create those additional investments. those additional connections. You're still going to get that if it's part of the original growth plan, if that's the second tier that you're also involved with. The company value increases, overall market capitalization grows. So more and more people are finding out about it. If we have more people getting on that are actually paying fees through their ticket prices, then that gives longevity to the company. We can't be short-sightedness in thinking this way. So as I kind of wrap up here, I wanted to do a couple of quick numbers here so you to see. So balancing short-term impact versus long-term value. That's the way you need to look at this play when we look at HeySummit. All right. So assessments needed. Shareholders must evaluate the purpose behind new shares issuance. Right. We need to understand that. And those are some of the questions people have asked, been in the notes in the lifetime deal. Also, short-term concerns, immediate ownership dilution, and possible market reaction may cause temporary value decreases. And this is what they're kind of facing right now. They're like, wait, you're diluting me. I've already been in since 2019. And what they're saying is, no, we're back. We're trying to raise funds, trying to do additional things. And I'm going to show you now why the deal that you have, even in 2019, is better than any deal that you'll ever get, even at that deal. The deals are even sweeter now, but they're more expensive, and they want to bring more people into the fold, right? So you also get long-term potential capital for growth can increase overall company value, benefiting all shareholders eventually. So everybody, the whole tide is going to raise by bringing in new investors, right? So I think what people do is they say, well, I purchase this at this tool. So let's look at this. So this is HeySummit. This is for the highest tier that they got last year. I mean, in 2019, they were able to get 12,000 attendees. Now, I don't know anybody. There's a couple of people, maybe less than 1%, that can get 12,000 people to an event, right? But if you could, and if you charge each person $1,000, or if you charge them $100, you're going to make your money back on one event. This particular, so everything seems to be tied to the growth plan, right? That's what they're giving, the growth plan. So the way it breaks down and the way the rules work mostly for Appsumo is they'll tie it to a plan. This particular offering was tied to the growth plan. So meaning on their website, if they added anything new here on the public website, then you would be entitled to that. And it's almost like on the back end of the system, it's like, hey, we made all growth plans. If we added this, then we're going to add that, and we're going to have that. So say, for instance, here where it says integrated affiliate platform, if they go and they said some of the money that they were going to be raising was going to improve the integrated affiliate platform, then you're going to get that. Even as a prior owner, you're going to get that because you're part of this plan. These are offerings, right? So let's look at the first offering. The first offering back in 2019, they charge you a 1.5% transactional fee. Now, what you got was unlimited hosts, and you got 12,500 attendees, and you can do 15 events at a time, and you got unlimited speakers, unlimited team members, and a remove HeySummit branding. But you only paid $295, right? So this is back in 2019. Now, fast forward for the highest tier. Now it's $345, right? But you don't get the unlimited team members, right? And you do get more active events, and you get more attendees. But again, who's putting in 35,000 people? I don't know who's actually doing that. And if you are, that's great. But the transactional fee is actually a lot less. So let's go back to that. So you're getting unlimited team members and unlimited hosts, right? So that's kind of hard to reduplicate even from a technological. That's why it makes it so hard. You can't just mix and match. This is an offering. So these are like public offerings. Each offering is different, right? So this particular one, you get unlimited hosts, you get 12,500 attendees at $295 one-time cost. Never make a purchase again, ever, right? So when you go here, let's keep in mind the 12,500 attendees, and let's look at the unlimited hosts. Well, when you fast forward today, I just captured this today, you only get 10 members, right? So you only get 10 members, and to get 12,000 attendees, you're going to get a 3% transaction fee, and you're paying $171 a month. So the deal that you have, even if you purchased the deal in 2019, is still a better deal. It's a better deal. It's not the best deal now, but the best deal now is $345, and it costs a little bit more. But is it the best deal if you really need more team members, right? Because the prior deal gives you unlimited hosts and unlimited team members and unlimited speakers. The new deal does not give you unlimited speakers, right? You only get 25 team members here, right? You get the higher amount of attendees. But again, if you're getting in 35,000 people, or even in this fact, if you're getting in 12,000 people, then $295 one-time costs is got to be 3,000% over what you would ever have made, right? Versus a monthly cost of $171. This is really pays for 2 months of the current plan. So the plan you got back in 2019, right? So let's do the numbers on that. I don't have it in front of me, but I did do the numbers. The average inflationary cost from 2019 to 2025 is about 3.61%, or let's call it 4%. So you're talking about a 4% increase every single year, year over year, on average from 2019 to 2025. That is a significant amount of inflation. And you've only paid a one-time cost of $295. So while server costs and everything else is going up, everything on average has gone up about 4% a year. So in closing, what I wanted to tell you was, I really believe that this is a good deal. With the last deal was a good deal. This deal is a good deal. You're losing less. You don't get unlimited. And I really believe this is a good deal. I am going to be doing some other things to break things down. We need to, as LTDers, or we need to understand the true value that we have and the tools that we purchase and how to deploy them properly. This has been brought to you by Hackpack University. You guys need to get on the waiting list. It's going fast. This is the kind of things that we're doing over here. Hi, I've been Jenny Jones. I'd like to thank you. You guys have been great. You guys take care. Goodbye for now.